Fatal mix. Triggered for stocks, Bitcoin is finished. Warns economist. Fatal mix. Triggered for stocks, Bitcoin is finished. Warns economist. Thursday's session wasn't just another down day, it was a signal. A veteran macro strategist just went on record, selling equities, dumping digital assets, rotating into hard money. His reasoning? The toxic combination that has destroyed portfolios in every major crisis since 2000. Lower growth, higher rates, simultaneously. And this time, the AI trade that propped up trillions in market cap just lost its fundamental logic. Big tech is spending more. The market is rewarding less. Bitcoin's use case? Quote, finished. Unless something changes in the next few weeks, what comes next could redefine how capital is allocated for the next decade. Welcome to Financial Crisis Explained. If you've been navigating markets long enough to remember when research meant more than scrolling, do me a favor, hit that subscribe button and drop a comment. Tell me where in the world you're watching from today. The market doesn't usually announce when the rules have changed. There's no headline that reads "Old Playbook Retired." Instead, the shift happens quietly across multiple sessions until one particular day crystallizes what's been building beneath the surface. Thursday, February 12th, 2025 was that day. By the closing bell in New York, the S&P 500 had shed over 1%. The Nasdaq Composite fell harder, down nearly 2%. But the numbers themselves weren't the story. Markets declined regularly. What mattered was the pattern underneath, the simultaneous breakdown across asset classes that typically don't move in lockstep. Technology stocks, which had carried equity indices for 2 years straight, were hit hardest, not because of earnings disappointments or regulatory threats, but because the market's tolerance for their valuation premium had evaporated. The same companies, the same business models, the same revenue projections, but suddenly, a different price. Gold, traditionally the asset investors flee to when uncertainty rises, didn't catch a bid. It dropped over 1%. That's unusual. In risk-off environments, gold typically holds or rises as equities fall. The correlation broke. Bitcoin, already under pressure for weeks, slid another 4%, dipping below key technical support levels that had held since late January. The cryptocurrency market, which had spent months trying to convince institutions it had matured beyond speculation, looked anything but mature. This wasn't a rotation. Rotations involve capital moving from one sector to another, from growth to value, from equities to bonds. This was something else entirely. A broad-based repricing driven by a shift in the two variables that matter most to asset valuations, growth expectations and interest rates. The fatal mix had been triggered. The term isn't new. Market veterans use it to describe the specific economic conditions that destroy portfolio returns faster than almost any other scenario. It happens when growth slows, or is expected to slow, while interest rates remain elevated or continue rising. Separately, either condition is manageable. Slower growth means central banks eventually cut rates, supporting valuations. Higher rates, if accompanied by strong growth, can be absorbed by expanding corporate earnings. But together, they create a vice. Lower growth reduces future cash flow expectations. Higher rates increase the discount applied to those cash flows. The mathematical result is straightforward. Lower present values. Lower present values mean lower stock prices. And if the repricing happens quickly, it doesn't feel like a correction. It feels like a collapse. By Friday morning, a prominent macro strategist appeared on a major financial network and made his position explicit. He was selling equities, not reducing exposure, not trimming around the edges, selling. His reasoning centered on the exact dynamic now unfolding. Growth indicators weakening while the bond market priced in a higher for longer rate environment. But he went further. He specifically called out the AI trade, the narrative that had justified extraordinary valuations across big tech for the past 18 months. The logic had been simple. Companies spending tens of billions on AI infrastructure today would generate exponential returns tomorrow. The market had believed it, until now. The problem wasn't that AI spending had stopped. It had accelerated. Microsoft, Google, Amazon, Meta, all committed to increased capital expenditures in their most recent earnings calls. But the market's response had reversed. Instead of rewarding the investment, investors began questioning the timeline to monetization. When does this spending translate into revenue? When do margins expand? When does the payoff justify the outlay? Those questions don't get asked when growth is strong and rates are low. In that environment, the market gives management teams the benefit of the doubt. Vision gets rewarded. Long-term thinking gets premium multiples. But when the fatal mix triggers, when growth softens and rates stay high, patience evaporates. The strategist's final comment landed hardest. When asked about Bitcoin, he didn't hedge. He said it was finished unless a dramatic catalyst emerged within weeks. Not struggling, not consolidating, finished. That word hung in the air because it represented more than one analyst's view. It captured a broader institutional sentiment shift. a reassessment of what constitutes a store of value when monetary conditions tighten and risk appetite contracts. The question for anyone managing capital, building a business, or planning financial strategy became unavoidable. Was Thursday an anomaly? Or the beginning of a regime change that would redefine investment logic for years? The answer required looking deeper into the mechanics of the growth rate collision itself. There's a reason experienced traders get quiet when growth and rates move in opposite directions simultaneously. It's not panic, it's recognition. They've seen this movie before, and they know how it ends. The fatal mix doesn't operate on emotion or speculation. It operates on mathematics. And mathematics, unlike market sentiment, doesn't negotiate. Start with the foundation of equity valuation. Every stock price at its core represents the present value of future cash flows. That's not theory, that's accounting reality. An investor buys a share today based on what they expect that company to earn tomorrow, next year, and across the decades ahead. But those future earnings can't be valued at face value. They must be discounted back to present terms using an appropriate rate. That discount rate has two primary components: the risk-free rate, typically represented by government bond yields, and a risk premium that reflects uncertainty. When interest rates rise, the discount rate rises. When the discount rate rises, the present value of future cash flows falls. It's mechanical. If a company is expected to earn $100 million 5 years from now, that future cash flow is worth substantially less today if rates are at 5% versus 2%. Now add the growth variable. If economic expansion slows, corporate revenue projections compress, earnings estimates get revised downward, the future cash flows themselves shrink. So now the equation has been hit from both sides. Lower future earnings being discounted at higher rates. The valuation compression accelerates exponentially. This isn't hypothetical. The pattern has repeated across every major market dislocation of the past quarter century. In 2000, the Federal Reserve raised rates aggressively to cool an overheating economy, while growth began decelerating as the dot-com bubble's excess became apparent. The Nasdaq lost 78% of its value over the next 2.5 years. Growth stocks with no earnings and high valuations were obliterated first. But even profitable technology companies saw their multiples collapse as the fatal mix intensified. In 2007 and 2008, a similar dynamic emerged. The Fed had raised rates steadily through 2006 to combat inflation. By mid-2007, cracks in housing and credit markets signaled growth was deteriorating. The combination crushed equity valuations long before Lehman Brothers collapsed. The S&P 500 had already fallen 20% from its October 2007 peak by the time the acute crisis hit in September 2008. Even the more contained episode of late 2018 followed the script. The Fed raised rates 4 times that year while global growth indicators weakened. The S&P 500 dropped nearly 20% in 3 months, forcing the central bank to reverse course. Each instance shared the same underlying mechanism: higher discount rates applied to lower growth expectations. February 2025 presents that exact configuration once again, but with a dangerous amplification factor. Current bond yields remain elevated despite months of investor anticipation that central banks would pivot toward accommodation. The 10-year Treasury yield sits above 4%. That's not extreme by historical standards, but it's substantially higher than the sub-2% levels that prevailed during much of the post-2008 era. And critically, the bond market is pricing in expectations that rates stay elevated longer than previously forecasted. Simultaneously, leading economic indicators have turned negative. Manufacturing surveys show contraction. Consumer sentiment has weakened. Corporate guidance has become more cautious. The data doesn't suggest an imminent recession, but it clearly indicates deceleration from the growth rates that justified current equity valuations. The most vulnerable segment? Growth stocks trading at premium multiples based on future earnings potential rather than current profitability. This category now includes not just speculative ventures, but some of the largest companies in the world. The AI investment wave created a specific valuation paradox. Companies announced massive capital expenditure increases, tens of billions committed to data centers, chips, energy infrastructure, and software development. The market initially celebrated these commitments as evidence of transformative opportunity. Valuations expanded. But AI infrastructure spending has a critical characteristic. It's front-loaded cost with back-loaded revenue. The expenses hit immediately. The return on investment materializes over years, not quarters. In a low-rate, high-growth environment, that timeline is acceptable. Investors can afford to wait because their cost of capital is low and alternative opportunities aren't compelling. In a high-rate, low-growth environment, that same timeline becomes a liability. The cost of capital rises. Alternative investments, including simply holding government bonds at 4% yields, become more attractive. And suddenly, the question shifts from how big will AI revenues eventually be to when exactly will AI spending generate positive returns, and what's the opportunity cost of waiting? That's not a question easily answered with precision. which means it's a question that invites skepticism. And in markets, skepticism applied to premium valuations leads to multiple compression. The compression doesn't happen uniformly. Different sectors and companies face different levels of exposure to the growth rate collision, but the direction is consistent. What makes February 2025 particularly significant is that this repricing is happening while corporate balance sheets remain generally strong and unemployment remains low. This isn't a crisis-driven sell-off. It's a valuation recalibration driven purely by the shift in growth and rate dynamics, which means traditional crisis playbooks don't apply. And that reality is forcing a fundamental reassessment across all asset classes, including those that had been positioned as alternatives to traditional equity exposure. Bitcoin was supposed to be different. That was the promise. That was the pitch. When traditional assets faltered, when central banks debased currencies, when inflation eroded purchasing power, Bitcoin would stand apart. A decentralized, algorithmically limited store of value, immune to the policy mistakes that had repeatedly destroyed fiat wealth throughout history. For over a decade, that narrative survived market cycles, regulatory uncertainty, and technological challenges. Bitcoin crashed 80% in 2018. It recovered. It crashed 70% in 2022. It recovered again. Each time, believers pointed to the same fundamental thesis. Fixed supply, 21 million coins, no central authority capable of printing more. Then, a veteran economist went on record with a single word that cut through years of accumulated conviction. Finished. Not challenged, not under pressure, not facing headwinds. Finished. Unless, he added carefully, some dramatic catalyst emerged within weeks to alter the structural trajectory. But absent that catalyst, the use case had collapsed. The statement landed with particular force because it didn't come from a cryptocurrency skeptic who had opposed digital assets from the beginning. It came from someone analyzing capital flows, institutional behavior, and monetary conditions without ideological attachment to any specific asset class. He was simply reading the data, and the data had shifted measurably. Institutional involvement, which had been positioned as Bitcoin's maturation signal, was reversing. Corporate treasury allocations that made headlines in 2021 and 2022 were being quietly unwound, not because companies had lost faith in blockchain technology, but because the financial logic that justified holding a volatile, non-yielding asset on the balance sheet had evaporated. When interest rates were zero and inflation was accelerating, holding Bitcoin carried minimal opportunity cost. Cash earned nothing. Bonds earned nearly nothing. If Bitcoin appreciated even modestly, it outperformed traditional treasury management. And if inflation surged, the fixed supply narrative provided theoretical protection. But with risk-free rates now above 4%, the calculation inverted entirely. Every dollar allocated to Bitcoin was a dollar not earning a guaranteed 4% annual return in short-term treasuries. That's a measurable, certain opportunity cost. And it required Bitcoin to appreciate more than 4% annually just to break even on an opportunity-adjusted basis, before accounting for volatility risk. Corporate CFOs are not philosophers debating monetary theory. They're stewards of shareholder capital operating under fiduciary obligations. When the opportunity cost of holding a non-yielding volatile asset rises above 4% guaranteed elsewhere, the allocation decision becomes straightforward. The institutional retreat wasn't limited to corporate treasuries. Exchange-traded fund flows, which had surged when Bitcoin ETFs launched, had plateaued and then reversed. Hedge fund positioning data showed net short interest increasing. Derivatives markets reflected declining demand for upside exposure. But the structural challenge went deeper than flows. It went to the core use case itself. Bitcoin's original proposition centered on three primary utilities: a medium of exchange, a store of value, and a hedge against currency debasement. By early 2025, all three pillars faced fundamental questions. As a medium of exchange, Bitcoin had largely failed. Transaction speeds, cost, and volatility made it impractical for everyday commerce. Merchants who accepted it in 2017 had largely abandoned it. Stablecoins, ironically built on blockchain infrastructure but pegged to fiat currencies, had captured the payment use case that Bitcoin was supposed to own. As a store of value, the digital gold narrative required Bitcoin to demonstrate low correlation with risk assets during periods of stress. It hadn't. When equities sold off sharply, Bitcoin sold off harder. When the fatal mix triggered in early February, Bitcoin didn't decouple. It amplified the move downward. That's not how stores of value behave. That's how speculative growth assets behave. As a hedge against currency debasement, Bitcoin faced an unexpected competitor: central bank digital currencies. Governments globally were advancing plans for state-backed digital currencies that offered the technological benefits of blockchain with the stability and legal backing of sovereign issuers. For users who wanted digital payment efficiency without volatility, CBDCs provided a direct alternative that eliminated Bitcoin's primary remaining use case. And then there was regulation. The coordinated global move toward comprehensive cryptocurrency oversight had accelerated through late 2024 and into 2025. Tax reporting requirements tightened. Know your customer provisions expanded. Cross-border transfer restrictions increased. The regulatory arbitrage that had allowed crypto to flourish in gray zones was systematically closing. None of this meant Bitcoin would go to zero. Markets rarely work that cleanly, but it did mean the fundamental justification for institutional scale allocation had weakened substantially. And in capital markets, when the justification weakens, price follows. The Economist declaration of finished reflected that reality. Without a dramatic catalyst, a major sovereign adoption, a technological breakthrough that restored the medium of exchange utility, or a complete reversal in monetary policy back towards zero rates and quantitative easing, Bitcoin faced a structural repricing toward its utility value rather than its speculative premium. Meanwhile, the asset Bitcoin was supposed to replace was experiencing renewed institutional interest. Gold, the 5,000-year-old store of value that cryptocurrency advocates had dismissed as a barbarous relic, was attracting capital again. Not from retail enthusiasts, from central banks, from sovereign wealth funds, from institutional allocators reassessing what constitutes durable wealth preservation in a world of persistent geopolitical uncertainty and currency instability. Gold doesn't yield, it doesn't generate cash flow, it can't be used for payments efficiently. By modern financial theory, it shouldn't command the allocations it receives, yet it does. Because across centuries of monetary experimentation, regime changes, and technological disruption, gold has retained value, not because of technology, because of consensus, a global cross-generational agreement that gold represents stored purchasing power. That consensus doesn't shift quickly, and in an environment where the fatal mix was compressing valuations across growth assets and forcing reassessment of speculative holdings, the oldest store of value was being reconsidered with renewed seriousness. The verdict on Bitcoin wasn't final, markets never are. But the burden of proof had shifted, and that shift carried implications far beyond cryptocurrency markets. It signaled a broader recalibration across all alternative assets, a reassessment of what constitutes genuine wealth preservation versus what constitutes speculation dressed in institutional language. The fatal mix doesn't announce its duration. It doesn't provide a timeline for when conditions normalize or a roadmap back to the environment that prevailed before. That uncertainty is precisely what makes it dangerous for capital allocation. Investors, business leaders, and financial strategists must operate without knowing whether they're navigating a 3-month disruption or a 3-year structural shift. But uncertainty doesn't eliminate the need for decision-making. It intensifies it. The first principle of positioning for a growth rate collision is abandoning recency bias. The strategies that worked during the previous cycle, buying technology growth stocks on every dip, allocating to speculative assets with asymmetric upside, maintaining minimal cash positions to stay fully invested, those approaches were optimized for a specific set of conditions: low rates, abundant liquidity, expanding valuations. When those conditions reverse, the strategies don't just underperform, they actively destroy wealth. Portfolio construction in the new regime requires a fundamental reorientation toward durability rather than growth maximization. Durability, in this context, means businesses and assets that maintain value and generate returns independent of whether economic growth accelerates. That's a more stringent filter than most investors apply during expansionary periods. It eliminates companies dependent on valuation expansion rather than cash generation. It eliminates business models that require sustained access to cheap capital. It eliminates assets whose value proposition rests primarily on narrative rather than fundamental utility. What remains after applying that filter? A narrower universe, but one with specific characteristics. Businesses with genuine pricing power, the ability to raise prices without losing customers even as input costs rise, and demand softens. This isn't about monopoly or market dominance necessarily. It's about delivering value that customers cannot easily substitute. Essential services, mission-critical infrastructure, products or platforms that have become embedded in workflows to the point that switching costs exceed price increases. These businesses exist across sectors. They're not confined to defensive categories like utilities or consumer staples, though those sectors naturally contain examples. Pricing power appears in software businesses with sticky enterprise customers, in industrial companies with proprietary technologies, in healthcare firms with unique therapeutic capabilities. The common thread is inelastic demand, revenue that persists regardless of macro conditions. Equally critical are balance sheet characteristics. In a high-rate environment, debt becomes expensive, not just for new borrowing, but for refinancing existing obligations. Companies carrying significant leverage face a mathematical problem. If their cost of debt rises faster than their revenue growth, margins compress. Free cash flow declines. Equity value erodes. The inverse is also true. Companies with minimal debt, strong cash positions, and self-funding operations gain strategic flexibility exactly when competitors lose it. They can invest countercyclically, acquire distressed assets, return capital to shareholders through buybacks when valuations compress. Debt-free balance sheets weren't particularly advantageous when rates were zero. At 4% and rising, they become competitive moats. Beyond individual business selection, geographic diversification requires reassessment. The fatal mix doesn't impact all economies uniformly. Regions with different monetary policy trajectories, different exposure to global trade dynamics, and different domestic growth drivers will experience different outcomes. Emerging markets with commodity-based economies may benefit if hard asset prices strengthen while financial assets weaken. Developed economies with aging populations and structural productivity challenges may face more prolonged stagnation. Currency fluctuations will amplify or dampen returns depending on positioning. A purely domestic equity allocation made sense when the U.S. market was the sole engine of global returns. In a regime where leadership rotates or disperses, geographic concentration becomes a liability. Fixed income, largely dismissed during the zero-rate era as offering inadequate returns, has regained relevance, but not all fixed income. Duration matters, credit quality matters. In an environment where growth is slowing and defaults may rise, investment-grade bonds with shorter maturities provide income without excessive principal risk. High-yield credit, which performed well during the expansion, faces twin headwinds. Rising rates increase borrowing costs, while slower growth pressures revenues. The spread compression that made junk bonds attractive has reversed. Then there's the hard asset question. Commodities, precious metals, real assets with intrinsic value independent of financial engineering. Gold's renewed institutional interest isn't accidental. When financial assets are repricing downward and currency stability faces questions, physical assets with no counterparty risk and centuries of value recognition become portfolio anchors. Gold doesn't solve every problem. It doesn't generate yield. It doesn't benefit from economic growth. But it doesn't require economic growth to maintain purchasing power. In a fatal mix scenario, that's not a weakness, it's a feature. Broader commodity exposure depends on specific supply-demand dynamics in individual markets. Energy, metals, agriculture, each trades on distinct fundamentals. But as a category, real assets offer inflation protection and low correlation with financial assets during periods of simultaneous pressure on growth and rates. Technology sector positioning requires particular nuance. The blanket assumption that all technology stocks face equivalent headwinds is incorrect. The sector has bifurcated sharply. Infrastructure providers, companies supplying the physical and logical building blocks of digital economy, face different dynamics than consumer-facing platforms. Cloud infrastructure that enterprises have already adopted and integrated into operations generates recurring revenue regardless of whether new AI applications monetize successfully. Payment processors handling essential transactions maintain volumes even as discretionary spending slows. Cybersecurity services become more critical, not less, as threat environments intensify. Conversely, platforms dependent on advertising revenue, consumer discretionary spending, or continued valuation expansion without earnings support face direct exposure to the fatal mix. Their business models haven't broken, but their valuations assumed conditions that no longer exist. The discipline required for navigating this environment is position sizing and liquidity maintenance. Conviction in individual positions must be balanced against acknowledgement of elevated uncertainty. Concentrated bets that would have been justified during the expansion carry asymmetric downside risk now. Diversification isn't about hedging against being wrong on a specific thesis. It's about hedging against being right on the thesis, but wrong on timing. Maintaining liquidity, actual cash or cash equivalents, not just the theoretical ability to sell positions, provides strategic optionality. If the repricing accelerates and valuations compress further, liquidity allows deployment at more attractive entry points. If conditions stabilize faster than expected, the opportunity cost of holding some cash at 4% returns is manageable. This isn't market timing, it's regime recognition. The fatal mix of lower growth and higher rates has been triggered. That's not speculation. It's observable in economic data, interest rate markets, and cross-asset price action. How long it persists and how deep the repricing extends remains unknown. But the strategic response is clear. Shift from growth maximization to capital preservation. Prioritize durability over optionality. Reduce exposure to assets whose value depends on conditions that no longer exist. Increase exposure to assets that maintain value independent of whether the previous regime returns. The market doesn't reward those who predict the future most accurately. It rewards those who position appropriately for the range of possible futures and survive long enough to benefit when clarity eventually emerges. That survival depends on recognizing when the rules have changed and acting accordingly before the full weight of the fatal mix has fully compressed valuations across the entire capital structure. The regime has shifted. The question is no longer whether to adjust. The question is whether the adjustment happens proactively or gets forced reactively at substantially worse prices.